Let's get into some market commentary of the day. One of the big debates among economists going into 2024 is the timing of Fed rate cuts. Deutsche Bank projecting a mild recession that will lead to 175 basis points in cuts starting the first half of 2024. Pretty aggressive compared to the market, which, according to the bank, is now pricing about 100 basis points of cuts. Here to break down all of this and the outlook is our very own Madison Mills. Maddie, what do we know so far here?
Yeah, so I want to look at a couple of the different calls that we're getting from the big banks on what we're seeing when it comes to rate cuts and when we're going to start seeing those cuts. That's the, of course, big question here. Sticking with what you mentioned, Deutsche Bank, Brad, projecting a total of 175 basis points of cuts starting in June. Now, interestingly, they did look at something called the Taylor rule, which I'm not going to get into the specifics of, but basically an economic theory that would indicate that the economy is slowing down a little bit faster than the Fed wants it to, given softening in the labor market and continued decreases in inflation. Deutsche Bank says that if that rule indicates that we are heading toward a recession, we could see the Fed start to cut as early as H1 of next year. And if you look at that chart, you can see the difference in Deutsche Bank's projections for the economy versus what we're seeing on the street now. But interestingly, Deutsche Bank's commentary not as optimistic as Bank of America, saying that we could see upwards of 50 basis points of cuts at that first meeting there. And they're also predicting cuts across the entire globe, not just here in the United States, and continuing calls across the street for more rate cuts heading into the new year, particularly following Waller's comments yesterday, guys. I'm really curious to see how Powell kind of potentially walks that back heading into the 11 a.m.
Yeah, Maddie, it's going to be very interesting to hear the tone and the rhetoric that we're going to get from Powell today, because like you just mentioned, we have had a number of policy officials in terms of be a little bit more optimistic that the Fed is actually progressing in its fight to tame inflation finally, that there are some reasons to be a bit optimistic that policy right now is restrictive enough in order for the Fed to eventually get inflation back to that 2%. I'm curious also how economists are going to kind of balance this, right? Because we talk about so much uncertainty, the fact that the landscape can really change extremely quickly, obviously, but so much of it is also going to be placed on the labor market and the strength and resilience and whether or not the job side of the equation is able to hold up and keep the economy on somewhat of a track.
Well, and that's why it's so interesting that the Fed commentary always fascinates me, because they spent so long talking about long and variable lags and that, we needed to wait a little longer to see the impact of their rate hikes. But we're starting to see this 2% number in the Supercore number with CPI there yesterday. So a lot of economists today wondering, are they potentially pushing us into that hard landing as well? Tim Dewey is an economist I follow who's great, and he talked about how if we're starting to see that 2% number already, and to your point, Shauna, if the labor market continues to cool and soften a little bit more, could we see that hard landing impact coming in if the Fed doesn't pivot quickly and get a little bit more dovish at the start of the new year as opposed to waiting until June?